Good afternoon and welcome to today's webinar, The Basics of Commercial Credit Analysis. We are excited to have everybody on today. Before we jump into the webinar content, I just wanted to roll through some quick housekeeping items. First, you'll receive a copy of today's slides and a recording of the webinar and a follow-up email after the session. But there is also, the slide deck has already been PDF'd and has been placed in the handouts section of your GoToWebinar toolbar on your screen if you are using a computer, as well as there is another resource handout there for you to use with other content written and created by some of the experts at Abrigo. Additionally, if you have any questions throughout the presentation today, you can go ahead and use that same GoToWebinar toolbar on your screen and type in those questions. If we're not able to get to your questions live on air, we've got some time reserved at the end. But if we're not able to get to them, we'll follow up after the presentation is over. A little bit about Abrigo if you aren't familiar with us. Formerly Bankers Toolbox, a BSA anti-money laundering and fraud detection solution provider. SageWorks, a lending and portfolio risk solution provider, MST, an allowance solution provider, and Farron, a risk management solution provider, all came together to become Abrigo. Abrigo is a leading technology provider of compliance, credit risk, lending, and asset liability management solutions that community financial institutions use to manage risk and drive growth. With over 2,500 institutions using our solutions today, Abrigo is poised to make big things happen. So if you'd like to learn more, I invite you to go check out abrigo.com. So a little bit about our presenter today. I'll introduce Rob. Rob has over 28 years of experience in the financial services industry. He spent 15 years at Wells Fargo in various strategic and leadership roles. And he's spent time in finance, servicing, fair lending, pricing, strategy. So a little bit of everywhere. And for the past couple of years, Rob has worked closely with financial institution leaders and regulatory agencies to develop a credit administration suite of tools designed specifically for community banks and credit unions, and now sits as a senior advisor on our advisory services team here at Abrigo. Rob's also a faculty member at the Graduate School of Banking in Madison, Wisconsin. So he's got a wealth of experience, and I'm super excited to have him on today. And so with that, I'm going to go ahead and pass things off to Rob.
Thanks, Thomas. Excited to be here and talk to a bunch of credit analysts that are out in the field. How exciting to be a credit analyst in 2021, right? So a lot of changes, a lot of uncertainties, and with the pandemic and everything else we have going on, like I said, if you were ever going to start a career, what a fun time to do it when there's a lot of nuances and changes going on out there right now. So today we're going to really focus on the basics of commercial credit analysis. So we're going to set the table today with a few topics. I know at the end we'll talk about, we do have a couple of additional webinars coming up on that will go a little deeper into some of these topics. But today we're going to set the table. We're going to talk about credit risk in general, the purpose of assigning credit risk. We're going to talk a little about the 5 C's of credit and redefining some of those classic definitions to make them work in today's environment. We'll talk about objective loan analysis. So what key ratios are used in commercial loan packages, and how do you weight those? And we'll talk a little about scales and some things like that. And then we'll kind of end with credit memos. So I know that's kind of a unique thing. Every financial industry kind of has their own way that they create their credit memos. And we're going to talk a little about best practices within credit memos to get the most out of the credit analyst work that you're doing to actually get your loan committee and your board members to read those things so they can make good decisions for your loan portfolio. So with that, Thomas, we'll go ahead and jump right in. And we're going to start with credit risk in general. You can go to the next slide, Thomas. And so when we talk really about, and we're going to focus on credit risk, but there's really 3 inherent risks that all financial institutions face, right? And when we talk about enterprise risk, usually these are the 3 we talk about: is credit risk, interest rate risk, and liquidity risk. And when we went through the last financial crisis in 2008, it had a bunch of issues. A lot of people thought it was liquidity risk, but it was really a combination of credit risk that caused liquidity risk issues. And so these 3 things are tied very closely together, and sometimes one goes up and one goes down. Sometimes they all go the same direction. And so But today, once again, we're going to really focus on credit risk, which is the obligation to pay back depositors regardless of whether our loans are repaid. So we're going to take folks' money and we're going to lend it out either by investments or in loans. And we're hoping that those folks pay us back so that when the depositor wants to withdraw their funds, it's there for them. And so credit risk is really, once again, looking at the balance sheet side, the asset side of the balance sheet, making sure we're making good deals. So Thomas, you can go ahead to the next slide. So there were some good interagency policy statements that came back a ways ago that are still very applicable, especially as we start talking about institutions thinking about moving to CECL again. And so, when you really talk about credit administration, there's really three legs of a stool, and it's really credit risk, kind of this loan grading that we're going to talk about here today. There's stress testing your loan portfolio to understand maybe what some hidden risks are that are buried in there. And then we have our allowance calculations all fit together. Well, this interagency policy statement actually came out of the allowance leg of the stool. However, it really talked about loan classification and credit grading systems. And so really hits to the heart of what credit analysts do and how we kind of assign credit risk to individual loans in the portfolio. And you'll see when you talk about loan grading systems, some people call them underwriting or risk matrices. They're all kind of the same thing. And really, a good loan grading system should have three things. One, it should promptly identify loans with potential credit weakness. It should appropriately grade or adversely classify loans, those with well-defined credit weakness and jeopardized repayment, so we know how to minimize that risk, right? And it should provide management with accurate and timely credit quality information for financial regulatory reporting purposes. That would be allowance calcs, stress testing, and understanding the impact to the financial institution's capital. So Thomas, you can go to the next slide. So that's really, when we talk about loan grading systems in general and the purpose, that's really what we're trying to account there for. Now, there's a fine line here, and a lot of times when I start throwing out the term loan grading, people get confused, and I really want to it's really no different than underwriting or risk scoring. It's really more a timing thing. And so when you ask what the relationship is between underwriting and loan grading, it's really, once again, a time. If you haven't done the loan yet, I kind of compare it to the horse is still in the barn, right? You can add covenants, you can change your pricing to account for some of that risk. Loan grading is kind of done after the loan is already on your balance sheet, right? It's an asset sitting there, and when you loan grade it, or you really are re-risk scoring it, you're really looking to see, has the risk profile changed on that credit, and you're really looking at performance and the impact on your potential reserves. But most folks use the same underwriting matrix, whether they're underwriting it versus when they're looking at it the second year or during renewals. And we'll talk a little more about that this afternoon as we talk about some objective key ratios that folks use for that. So you can go to the next slide, Thomas. So we have our first poll question, Thomas. I think you're going to handle this for me here.
Yep, I got it. So we're gonna open up. I think we got 4 poll questions today. And so the first one is, what percentage of your scorecards or grades are quantitative versus qualitative factors? We've got, less than half are quantitative, at least half are quantitative, almost exclusively quantitative, or you're not sure. Just gonna get a pulse of the audience, and we'll leave it open here for a few more seconds, and we'll share the results and see what Rob thinks of them. And if you're not familiar with GoToWebinar, the poll question will open up right on your screen. So if you're using a computer, it should be right there. All right, looks like we've got a good portion of the audience has responded. So I'm going to go ahead and close these results, and then let's take a look. So it looks like we've got about 36% aren't sure, Rob, and then our next biggest was about at least half are quantitative factors.
Gotcha. Yeah, and we're going to go through and define what some of those mean. But yeah, at least half, that's a good number. being a stat guy, I'd like to see a little more in the quantitative section, and I see that less than half are quantitative, is only 10%. So those are probably what I anticipated, Tom. It's the interesting thing about the environment we're in today. I think financial institutions have an opportunity to leverage the environment to potentially change or enhance some of the processes that they might have been doing, and said, well, it's too hard to change and do more quantitative calculations because we don't ask for that information. Well, having a pandemic and all these other things, and with the economy and concerns about C&I and commercial real estate in general, I would challenge your senior leaders to take advantage of the situation and capture more data so that you can do a more quantitative calculations. And we'll show the importance of that here as we go through today. So Thomas, yeah, you can flip to the next slide. So when we talk about loan grading systems or risk scoring matrices, there's a few things that they should all include. And when we talk about this, or when I talk to clients specifically about this, I really talk about what I call a dual loan grading system, which is like the best of both worlds, right? We want a quantitative or an objective portion of that so that you can compare apples to apples. So if you're a commercial real estate property in St. Louis and this is your debt service coverage, I'm going to get a certain grade, right? And based on those parameters of whether I'm in St. Louis, Des Moines, Florida, based on those quantitative calculations and ratios, I would get the same grade. And I can compare that with other industries either in that market or in that industry vertical, depending on if it's C&I or commercial real estate. So that kind of lets you compare things apple to apples when you do some objective analysis and comparative analysis. I like to layer in the subjective analysis. So we're going to spend some time on the 5 C's today. And the subjective analysis is the softer side, which means, hey, I know that they made it objectively look like X or like a 3, but there's some additional information I know about this member or customer that changes the objective grade. And so I like layering in a subjective component as well. And that's why we call it a dual loan grading system versus just a black box. And Thomas, you can flip to the next slide. And here's some just examples of whether they're objective or subjective credit factors to give you kind of a flavor of what I'm talking about here. And so debt service coverage ratio is an objective measurement, right? Do they have enough incoming revenue to cover their debt that they're obligated to pay in the next year, right? Management evaluation is a subjective component, right? So if you ask 3 of your senior lenders at your financial institution how to define what a good management team is, you're probably going to get different definitions. That's why we call it a subjective measurement. Loan to value, once again, objective, right? I know that 80% LTV is a calculation and it's objective to measure, right? Strength of guarantors is a little more subjective once again. And so is that the combined strength of the guarantors? Is it the strength of an individual guarantor that's helping if things go south? And another reason that I consider a guarantor more subjective is you're assuming they're going to pay you when things go south, right? So a lot of times they're not involved until the loan goes sideways, and then you're hoping that they pay some amount that they've said that they would on that. So that's why it's subjective. So you have objective and subjective components that really make up your risk scoring matrix. And it looks like we have another poll, Thomas.
Yeah, we had 2 nice and close together here. So our second one is, how compressed is your institution's current risk rating scale? We've got 1 to 3 categories, 4 to 9, 10 plus, or unsure. So I'll do the same thing as last time and leave this open here for a few seconds, and then we'll take a look at the results. All right, we still got responses coming in here. All right, I'm gonna go ahead and close it off here and let's take a look at what everyone said. So overwhelmingly, 4 to 9 categories, Rob, at 74%, and then I think next highest is 10 plus at 12%.
Yep. Yeah, and that's great. I know that I get the opportunity to teach at a few graduate school banking schools, and I know that we really push that 4 to 9, actually probably closer to an 8 or 9 point scale, which gives you enough dispersion of your loan portfolio so that you're not all your loans aren't you're not worried about split classifications and some other things that we'll talk about here in a few minutes. But that's good to know that a lot of financial institutions have migrated into that wider range of buckets. And so when we really talk about loan grading and risk scoring matrices, at the heart of every matrix is some type of measurement, right? And we call that a loan grading scale. So here on the screen, you'll see that this is a pretty common 9-point loan grading scale. You'll see that I have the 4 regulatory classified buckets that was part of some interagency policy statements back in 2005. But most loan grading scales are going to have the special mention, substandard, doubtful, and loss. And then a lot of the ones that are greater than 8 will have a 5 bucket, which is a pass watch, which is basically, I call it special mention's little sister, right? They're not exactly special mention, but they're kind of teetering on the edge. And both those classifications that fall in 5 and 6 should be somewhat temporary classifications, right? We're hoping to either figure out, is this loan going to recover and we're going to move it to a 3 or a 4, or is this loan going to continue to erode and we're going to move it to a 6, 7, or an 8 down the line. Now, a few things that financial institutions struggle with, and I know I have a mix of banks and credit unions on the phone today. You'll see historically, specifically in consumer, but also some in commercial as well, have a combination of alpha and numeric grading scales. So you might have a credit, a B, or a C credit. I used to work in the mortgage industry for Wells Fargo for several years, and we would have A credits and B credits, and when we pooled our loans. So I get it. But when we start pooling our loans and we start trying to leverage the information downstream, I really like financial institutions to migrate more to a numeric scale. You can still kind of have your alpha characters kind of outline. You can kind of see on the above where 1 and 2 is probably an A, 2.5 to 4 is a B, 4 to 5 is probably a C. But without a common measurement tool, it's hard. So if I was going to show a loan migration study, it's hard when there's like, you'll see that hybrid scale down in the bottom left-hand corner. And I've recently seen a couple financial institutions that I ran into this where they had a numeric with some alpha in the middle of it, like they have a 1, 2, 3, and a 4A, a 4B, and a 4C, and then a 5, 6, 7, 8, right? And at that point, it's confusing because now they're usually financial institutions run into this when they're not using an objective loan grading scale, but subjectively they're doing their credit analysis and everything ends up as a 4. And then they say, well, not everything's the same. So then they start splitting 4s up into 3 buckets, right? And so we can avoid a lot of those issues by just migrating to a total numeric scale with either decimal points or something else, so that we can actually look at weighted average loan grades and do some downstream analysis, which will help us in the long run. So when we talk about loan grading scales, and Thomas, this is a great slide that you pulled up here, non-numeric scores impact downstream analysis, right? I don't know how to do a weighted average on a 4A versus a 4B unless I have to manually convert that 4A to a 4.25 and a 4B to a 4.5 and a 4C to a 4.75. And so now I'm doing a bunch of extra work versus just actually assigning a numeric loan scale across the board. And when we do loan grading and stress testing and reserves, the nice thing about the work that you guys are doing up front is going to pay huge dividends downstream. So when we start talking about loan migration studies, and when I'm going to use the dirty word CECL, a lot of institutions probably haven't migrated over to CECL yet, and understanding some of those loss forecasts and based on loan grades or probability of default, loss given default, it's going to be important to know what some of these numeric numbers are to really help your analysis downstream. So Thomas, you can go to the next slide. Now, hopefully, once again, the whole point of having an 8 or 9 point loan grading scale is so you can have some differentiation across your loan portfolio. So in my previous example where people had 4A, 4B, 4C, it doesn't look like a bell curve, right? It looks like a bar chart because everything's in one bucket. The whole idea of having a little wider loan grading scale is that it should look like a bell curve, hopefully shifted a little to the left. You probably don't have a lot of ones. And I know there's a lot of financial institutions out there that don't have a lot of nines either. So, you probably have a lot of 3s and 4s and some maybe that are going out through some workout processes, probably not a lot of 1s or 2s either, but it should look like a bell curve. So that's ideally when I call it calibrating your loan grading model, right, or your loan grading system. Hopefully it looks something like a bell curve where you get a big chunk of it here in the middle, but you do show some tails on the ends there. Thomas, you can go to the next slide. And so once again, when we start talking about, we're going to talk about the 5 C's of credit. I'm going to go through some classic definitions and explain what they really mean, and then maybe we're going to talk about how we need to redefine some of these as we go forward in the future. And so the 5 C's of credit, the classic definitions, capacity, and this is probably, if I had to rank them 1 to 5, the most important C of the 5 C's. And this really measures the ability of the borrower to repay a loan by comparing expected income flow to the recurring debt the borrower is responsible for. And I did put a couple of the common ratios used in credit analysis that really relate to capacity. And that would be, there's multiple debt service coverage ratios that are out there. A lot of financial institutions customize those a little, but in general, any debt service coverage ratio, any debt to income ratio, very similar if you're looking at consumer stuff as well. But it's really that capacity. So making sure they have enough income, and that's why COVID really impacted some credit risk, is because it really changed the cash flow model of expected income for several industry verticals. So that's why capacity, I've seen a lot of financial institutions, when we're going to talk a little about how you weight and build a risk scoring model here in a minute, have weighted capacity so high now is because of the importance of understanding that income and cash flow. Collateral is another important one, and I'm going to talk about save and pay strategies here in a minute, but collateral is really a save strategy, which means it gives the lender some assurance that if the borrower defaults, that you at least have the opportunity to recoup potential losses. And that's why a lot of times when you look at risk-based pricing models, the lower the LTV, the better the pricing, right? Because there's less risk there. And that there's a little more security that even if they default on the loan, there's at least some collateral backing that up, that as painful as it is going through that process, you can at least once again recoup some of those losses so that you're not held holding a bad property or with a bunch of losses. You can go to the next slide, Thomas. Conditions historically have represented the terms of the loan. So when I talk about conditions, that typically refers to principal balance, payment terms, interest rate, pricing is probably in here as well. So when we talk about conditions, some financial institutions from a 5C perspective would also classify conditions as the intentions of the borrower on how the money will be spent. So when you give a loan, are they going to spend it on a bunch of new plastic presses if they're a manufacturing company, or if they're, a retail store? Is it inventories? What are the conditions that the borrower is going to use the funds for? And then character is somewhat confusing sometimes, because I think when we think of character in general, we think of the person's attribute or their willingness to pay back the debt when things go bad, right? So I used to tell people, you really don't know a person's character till they run into trouble, right? Everybody has good character when the economy's booming and there's no cash flow issues. It's when things get tight or go south that you're going to understand the character of your members or your customers. And typically today, people use credit reports, and FICO scores are some objective factors used when assessing the character of a borrower. You'll also see from a commercial side, management evaluation, reliance on the leader, and some other things like that when we talk about character of the 5 C's. Thomas, you can go to the last C on the next slide, I think. And then capital is the final 5C from a traditional or classic perspective. And that typically represents the amount of money that the borrower has put toward the investment that requires the loan. So, and I know we're talking about commercial, but I'm going to give you an ag example. So if you're going to buy a combine and the farmer's going to put down 100,000 or 20% of it, he's less likely to just walk away from the combine because he's going to lose that, right? So it's really understanding that down payment is a common measurement for that. And the thought behind that is the more skin the borrower member has in the game, the less willing they would be to walk away and default on the loan. And so it really was kind of a save strategy, right? That, hey, what do you have invested? Is it enough to keep you from just walking away? If it's not enough, chances are, and that's what we kind of ran into in 2008 and 2009, is that a lot of folks had investment property, but they thought they were underwater, so they decided it was easier to walk away. And it really relied on their capital they had invested and the character of those individuals that caused tons of problems back in 2008 through 2010 when we had our great financial crisis. You can go to the next slide. So I am recommending that we kind of revise the 5 C's and we add a couple other ones. And so the first one I would add would be the coronavirus / concentrations. And luckily for us in the 5 C's, coronavirus or COVID-19 both start with C's. And it is one of the more important things that you're going to have to digest here in 2021 when you look at member or customer that are applying for loans. And the question you need to ask yourself is, how has the pandemic impacted or changed the income or cash flows generated by that borrower, right? Are they in a industry vertical that has been significantly impacted, where, for example, a bar or a restaurant where you only can be at 50% capacity and maybe they don't serve food, that would really limit their ability to generate income, right? I know in several states they also limit hours, so bars can only stay open until 10 p.m. versus midnight. And so there's a bunch of things here that you're going to have to think through when you start underwriting credit based on the most recent pandemic issues that we're going through. So coronavirus, COVID-19, and understanding those concentrations that you might have on your balance sheet are important. And I would probably add that as one of the 5 C's. And the stimulus payment impact, when you look at those financials, you're going to need to understand, did the borrower receive direct government cash payments or qualify for loan forbearance? And so when you get your 2020 financials, and we'll talk about financials and objective analysis here in a few minutes, are you going to back those out? What is the real impact if they don't get additional payments? And how does that impact not only their debt service coverage ratios, but also their cash position? So Thomas, you can go to the next slide. And then the other one I would probably add is cash position. And so cash position is really the amount of current assets that the borrower can use to pay current obligations. So current and quick ratios are really probably the two most common kind of cash position ratios that folks use out there. You can also use, inventory turn, receivable to sales. I mean, there's a bunch of other ones out there, but current and quick ratios are some pretty easy down and dirty ones that you can look at to see, do I have enough current assets to cover my current liabilities from a cash position perspective. If you had some long-term assets, that debt to net worth are also fairly useful from a cash position perspective. So if things get tight, does the member or customer have enough net worth to cover debt? And once again, are they willing to do that in the current position? And you see here this PPP loans I stuck here in the bottom. Depending on how your financial institution handled PPP loans, whether you participated, whether you grew your commercial portfolio with clients that maybe weren't existing customers prior to PPP coming out, whether it was the first payment or the second payment, and then how did proceeds impact borrower's balance sheet? Unfortunately, when you have big stimulus packages, it's kind of like a free money free for all, right? Like the Wild West. So some companies that maybe didn't, there were some verticals that actually, from a commercial C&I perspective, have been very successful. Delivery, groceries, some other industries like that. Some restaurants had more takeout than they had folks eating in anyway, so they weren't really impacted. So if they got PPP proceeds, were they able to pad their balance sheet and their cash position, or were they in an industry that they really needed that PPP money to survive? And when you are doing your credit analysis in 2021, you're going to have to digest some of that information to understand, once again, capacity and this cash position to understand how you would risk grade those customers going forward. Thomas, you can go to the next slide. So you can kind of see that in my revised 5 C's of credit, I've kind of scratched out character and capital and really replaced that with coronavirus, COVID impact, and the concentrations from the industry perspective, as well as cash position, which maybe in the classic definitions, they threw that in capacity, but I think it's so important today as we're looking into the pandemic recovery that we understand that cash position of anybody that you're lending funds to going forward here. So these are my revised 5 C's. So hot off the press, you're the first folks that have ever heard of the 5 C's revised credit. So you can go to the next slide, Thomas. And we have another poll question.
Yeah, thanks, Rob. I can't believe after all these years we finally got some new 5 C's. So we've got our third poll question here to kind of launch us into the next session or section of the presentation, and it's just describe your current online loan application process. Are you currently offering one? Maybe you don't right now, but you're looking into it for the next year. You don't, but you're looking at it, in the long term. Or hey, we don't offer it, and it's not really something on our roadmap right now. Curious to get that, and then we'll take a look at the results. All right, we're seeing some results come in. I'll give it a few more seconds. All right, let's go ahead and close and share the results. So looks like we got just shy of half the audience at 43% currently offering, and then kind of a mix, Rob, of between that 17 and 23% mark of whether they're looking into it now in the next 12 months, or maybe they're not looking at it as hard.
Yeah, no, interesting results. I'm a little surprised that 43% already offer online loan application processes, but I think with PPP, it maybe push some of our financial institutions into doing that earlier. I love that another 40% are planning to do that. I think it really speaks of the current environment we're in having those e-signatures and being, I don't want to say touchless process, but having the ability to automate those processes and make it work in a pandemic is a great opportunity for the financial institutions that can get there. And then we have 17% that aren't planning that, but maybe based on their roadmap and their growth strategy, it's not a requirement, which is great as well. But you can go ahead and go to the next slide, Thomas. And here we're really going to talk about objective loan analysis. So we're going to give you some examples of some key ratios. I'm going to really talk about break it down and kind of we'll talk a little about how you measure, how you weight things, and then kind of pull this thing all together for you. But the first thing to understand is pay versus save strategies. I kind of alluded to that a little earlier with some of the different types of capacity, objective and subjective things that we went through. But a pay strategy really assesses the borrower's ability to make the agreed upon loan obligations. So that would be of the 5 C's. We talked about capacity, we talked about cash position, net worth. Those are really pay strategies, right? Is there enough cash in that the customer or member has that they can make payments when they need to? Save strategies try to limit losses when the borrower stops making payments. So bad things happen. A save strategy typically is my loan to value, right? It's a collateralized loan. I can at least go get the real estate or the inventory. I can sell it and mitigate some of my losses, right? Or I can call a guarantor and say, hey, the main borrower quit making the payments. Can you step in and help us out here? Those are really save strategies versus pay strategies. And when we look at objective analysis, I like a blend, but I really like to focus on the pay strategies, because if you're banking on doing a loan because of the save strategies, you maybe are setting yourself up for failure, right? On that side. And we'll talk about that a little later as well. So when we talk about, you can go to the next slide, Thomas. When we really look at objective loan analysis, there's really 3 steps that you look at kind of in this order. The first thing you're going to do probably is you're going to get financial statements, because we need a balance sheet and income statement to calculate most of our financial and ratio analysis. Now, we're not going to talk about if you need 7-year trends, because over the last 3 years, those numbers would be significantly different anyway for most industry verticals, right? However, we do need, I guess the question would be, are you going to use the most current financial statement history that you have, or are you going to use a projection? I think it depends on your vertical that you're looking at. If it's ag, I always like folks to look at what they're projecting to plant and get from an income perspective. If it's traditional C&I company or commercial real estate, you can maybe look at the most current history to get a trend on what's going on. When we get our balance sheet and income statement or tax return, which will combine those 2 things, we then are going to look and calculate a bunch of financial and ratio analysis, right? We're going to do a bunch of ratios. And then we're going to create some benchmarks, and we're going to do, once we have those ratios, we're going to do some comparative analysis. And this is where a lot of the magic happens for your institution, right? Some people might compare these to RMA medians. If you're a Abrigo customer, I know we have some SageWorks industry data you can compare to, or you might have some standard benchmarks that you use for debt service coverage ratios, like 1.2 debt service coverage is required. So you're then going to compare with that comparative analysis, and we're going to kick out some numbers. You can go to the next slide, Thomas. All right, and now this is an example of a financial spread. You can kind of see I'm comparing 18 and 19. This is pretty common, so I don't want to bore you. I know this is a basic class, so I at least wanted to throw out that, hey, we need an income statement, we need a balance sheet. Typically, you're going to probably get at least a couple years worth of financial statements. You might want to show a variance so you can see, is this company trending up or trending down? Obviously, you're going to know some additional information about this customer or member going into the analysis based on the vertical, were they in a floodplain, did something bad happen, in 2020, in 2019 or 2020. Once you have the financials, you see the little graphic on the right is really just some different ratios that are commonly calculated. You'll see those liquidity ratios or current ratio, quick ratio, working capital are just examples. You'll have a copy of this deck. If you have questions on what are some of the more common ones, you can look them up through RMA, or I'm happy to send you some information on that as well after the webinar. You'll see there's a bunch of financial leverage ones as well, and then profitability ones are some key ones as well. But really what we're going to do is we're going to take the financials, calculate ratios, and then we're going to compare them. You can go to the next slide, Thomas. So here are some considerations as we look at our financials and our ratios, specifically for 2020, right? It was a weird year, right? We didn't know. The first 2 months seemed great, and then the rug kind of got pulled out, and some industries just kind of went out of control. Some had the best years they ever had. So, we have a mix of things going on out there. So how has COVID-19 impacted the 2020 financials that you receive and the 2021 projections, right? Are they banking on additional stimulus money to make it? Maybe it's not required. Maybe they're in a growing business now because they were in delivery services and they're just booming. So, understanding the current condition and their financials from 2020 and their projection of 2021 are some key considerations. Has the borrower received government direct cash payments in provided financial statements? So I'm not sure if we have any ag lenders out there or not, but I know that ag actually exceeded expectations in 2020, mostly because of direct government cash payments. So if those direct government cash payments go away, how does that change your outlook or the capacity for that customer to pay you back, right? So you're going to want to understand the government cash payments or stimulus payments they received so that you understand the risk associated with that new deal. Are borrower financial statements over or understated due to stimulus package benefits? So did they get PPP loans? Did they actually get payment deferrals or forbearance programs that maybe either overstated income, shows more liabilities on a balance sheet? So you could have some other things going on with their financial statements. So these are some considerations as you're looking at your 2021 financial statements and doing your analysis that you're going to want to keep in the back of your mind as you make your recommendations on what to do with loans in 2021 going forward. You can go to the next slide, Thomas. All right, so here is typically how a risk grade matrix works, or a risk scoring model. And so here you can kind of see I broke mine up into things that we've been talking about so they make sense. Pay strategies, right? This is really capacity and cash position like ratios. And you'll see here at the bottom that section weight, I'm weighting 40% of my overall objective risk score on my pay strategies, right? I've actually seen this bumped up a little probably in the last year to 18 months. Even before COVID, it was actually being bumped up. A lot of times I see debt service coverage ratio by itself being 40% of a actual objective loan grade. But here you can kind of see you assign it. You'll see this benchmark range. And like I said, most of you folks out there are going to have something very similar where if the value based on the financials is 1.3, it falls in this range. Based on your loan grading scale, get somewhere between a 1 and a 9, and then you're going to weight it, right? This is just a weighted average loan grade. And here, once again, I added 4 ratios for my pay strategies. This section is going to equal 100%, and I'm weighting this whole section 40%, and I'm going to score it. You can go to the next slide, Thomas. Now, remember, I like dual loan grading system, which means I like the ability for you all to not only put your objective information in, but tell a little more story about why you think the member or customer should get the deal, right? And so even though it's subjective, you can still make it a little more objective and get it in your risk scoring model by putting a whatever benchmark range you want. Even though the answers are subjective, you can kind of see we've weighted another 30% on subjective information, and examples are on the left: dependence on a key leader, years in operation, management quality, and industry trends. And what this does is it drives a consistent grade versus having some lenders maybe are better at explaining why you should approve a loan versus maybe there are some greener lenders in the institution. And making these more objective, I think helps so that a deal wouldn't get approved because a senior lender did it versus a junior person doing the deal, right? We want to make sure that we have consistency in our grading across the board. So here you can kind of see I weighted this whole section 30%. And then the last section is the SAVE strategy, which is loan to value, guarantee support, and the quality of collateral. And I weighted this whole section 30%. And you can kind of see I have a benchmark range and I have a risk score of how it calculated on that. And this is really kind of how most loan grading risk scoring models work, is you're going to have different sections. You're going to pick different ratios or factors that you're going to measure, and then you're going to calculate a grade. You can go to the next slide, Thomas. And so here you can kind of see my total score was 361. I'm comparing it to my risk rating matrix, and I say a 361 equals, hey, this is going to be a watch. So you see my overall grade was a watch loan based on the 3 sections, and that's how I would assign the credit risk to this individual credit. All right, so a couple other things I wanted to touch about on the objective loan analysis, because it does enable a couple other key things that you're probably going to want to do when you're doing your initial underwriting on these commercial real estate and C&I deals. One is you're probably going to want to do at least some individual stress tests. I have an examples of a debt service coverage, which was really saying, what if their cash flow changes by 50%, 25 or 50%? What does that do to their ability to make their payments, right? Or you might look at changes in the collateral valuations. If the collateral drops by X, rerun it back through your scoring model and say, hey, if I'm in an adverse scenario and my debt service coverage ratios all drop by 25% and my collateral drops by 15%, my average loan grade across my portfolio would change from, you can kind of see the green bars to the yellow bars for the adverse scenario and to the red bars. So you can kind of see how the credit quality of your entire loan portfolio moves, as well as you might want to look at an individual credits itself to say, hey, this person would move from a 3 to a 5 based on, you know, my adverse or my severely adverse scenario. So when you're underwriting that credit, you at least know in the back of your mind what you have going on that front. You can go to the next slide, Thomas. All right, so we only have a couple minutes left. In the last section we're going to talk about is credit memos, and what, from a high level perspective, what do your decision makers need to see? So you can go to the next slide, Thomas. And we have our last poll, I think.
Yep. Let's see here. We've got, how does your institution currently enter data into the credit memo? Are you doing that manually? Do you have some sort of automated solution? Is there maybe a combination of manual and automated, or unsure? So we'll leave that open for a few more seconds. All right, let's go ahead and share the results. So we've got 42% at manual, 50% combination, and nobody's using fully automated, Rob.
I see that. Yeah, that is a little, with all these people, because we know we have 300 or whatever we have on here, Thomas. That's, I've never seen a 0 before. So that's
possible.
Interesting. Yeah, I could see the combination of manual gets kind of split between a combination of manual and 100% manual. And I do see that in the marketplace. So don't feel bad if you're part of that 42% that's in the manual data entry. Credit memos, how do I want to say this? They're unique in that every financial institution has their flavor of what a credit memo looks like, and it could be back from a senior lender created something back 15 years ago to every lender does their own and goes to loan committee. And we're going to talk about some of the benefits and drawbacks of and what should be included in one here in the next couple minutes before we let you loose today. So I kind of attack this by saying what best practice is, because so many institutions are doing manual ones. And as you heard in my background, I created a loan admin system that had credit memos part of it. And you can imagine that most lenders hated me after we did an installation because it didn't match exactly what they wanted to do, or they wanted to change it all the time to account for some of those subjective characteristics that are part of every deal that when you send a deal to loan committee. So here are some best practices. And you'll see, I just have a couple examples over on the right. I think this is probably the most important one and the hardest one for financial institutions to kind of get their arms around, is that they should be consistently applied, and you can use different templates for different either industry verticals, loan amounts, review types, or loan types. However, you should use at least a standard template so that when you go to loan committee, your board members get to see the same package over and over and over again, and they get used to looking for key things that they should be able to pull out and make a quick decision, which ties into the next one. Thomas, if you go to the next slide. I think this is critical because, like I said, we probably designed over 50 credit memos for financial institutions. And I think every one of them should probably start with an executive summary section that really is probably no more than 2 pages, because in today's environment, if it's more than 2 pages, a lot of times as board members and loan committee members get younger, not to pick on younger people, they get distracted easier. And if it's more than 2 pages, they can't, I don't want to say they lose interest, but they might tend to lose a little more interest than you might think. So having at least a 2-page executive summary that includes the customer overview and a final loan recommendation, right? So as a credit analyst, I'm saying, here's the deal. This is why I like it. And this is my recommendation, right? It should summarize your risk score, the terms and pricing, and any covenants that are required for you to recommend that you should move forward with the deal. Highlight any key financials and ratios, and include maybe a quick industry overview, but probably no more than a paragraph, because once again, they probably aren't, if you're approving 10 loans and they were all 75 pages, it'd be like reading one of the bills passed in Congress. I know it's going to read a 300-page document to understand if they should do the deal or not, right? And it should identify any exceptions to loan policy. So the goal is to provide enough information for your loan committee members to make a decision without overwhelming them with details, right? So always start with an executive summary. I've seen credit memos ranging from 2-page executive summaries all the way to 75-page novels that have everything you can think of about the customer or member and what they're doing on that side. You can go to the next slide, Thomas. On this recommendation or best practice, I would say provide additional supporting information in an appendix, right? We're going to talk about global cash flows in an upcoming webinar. So I didn't really talk much about it today, but it's important to have if you have a company that has, if you have a customer, remember, that is a owner of multiple companies that are maybe related somehow. We're going to want to, and we'll address that here in a few weeks. Guarantor analysis, any collateral analysis, and additional customer products and account information. So if they have a bunch of deposit accounts or 3 other loans, that's all great stuff to have, is supporting information. And if a customer has a business plan, if it was provided, it's great to put that in the appendix. And that's why I recommend calling it and having an executive summary first that kind of summarizes it. Then if you have any of those loan committee members or board members that really like to get in the nitty gritty, they can always thumb through and find what appendix it's on and go a little deeper if they want to, if they have questions. Automate where possible, tie into online application workflows and approval processes. So especially in today's environment, if you can get documents electronically, you can tie it into the app and you have an automated or a workflow. It's awesome if your credit memos are part of that, and people can kind of see consistently you're using the same ratios from credit presentation to credit presentation. And even that approval process, whether it's internal or external. So I know we created a lot of our credit memos required an internal signature either by a senior lender or two senior lenders if it was over a certain dollar size, building that into your workflow so that it's easy for these things to flow through your workflow and get to loan committee and approved, because your customer wants the money usually right away, right? So if it takes a week to create a manual credit memo, and then by the time you get it approved and all that, you really are risking losing that member or customer just based on your process, right? So automate where possible. It sounds like a lot of folks are in the process of doing that right now, which is great. And then practices to avoid. These are, and you might laugh because I know I'm talking to a lot of credit analysts here, but I've seen a lot when I've been out there talking to clients, and there's two types of lenders. There's lenders that really like to dig into the numbers, and then you have lenders that are really salespeople, and you're just trying to find that hybrid, right? You don't want to do so much analysis that you have a 150-page credit memo when you know that the decision's probably going to be made on the executive summary 2 pages, right? So don't kill yourself with this analysis paralysis problem. Customizations to standard memo layouts, try to avoid that, right? It's easier for whoever's approving these if they all look the same and they know exactly where to go. Usually you'll want to customize something when you're trying to get around an exception, or you have questions whether you should approve that deal, right? Try to stick to the templates and have those standard memos where you can. Once again, passing that weight test, you don't really need a 50-page credit memo. Once again, I know a lot of institutions, they kind of know they're going to do the deal before they even do the credit analysis. So it's that cost benefit scenario here that we want to make sure that you're thinking through when you're doing some of this credit memo work. Individual lenders preparing own custom analysis. This is one of my biggest fears, especially if it was on the consumer side and fair lending. As you mature in your lending abilities, you're probably better at writing these things up and getting them approved. You know, when you go to loan committee, what they're looking for. But if every lender has their own, then it's really hard objectively. And when you look at your risk portfolio as a whole, I think there's a bunch of weakness in there if you have everybody do their own custom analysis without any consistency being applied on that. So, and then recommendations based on only subjective analysis. We only had a small percent, I think 10%, that was basically subjective only. Much like I talked about trying to get more financial information and maybe changing your risk scoring model because of the environment we're in. Leverage the environment we're in and try to migrate to at least some objective component to your analysis. I know a lot of the biggest fear, and we fight it all the time, is the worry that you might not be able to lend to somebody you already have when you convert it from a subjective credit memo to a more objective credit memo. And I'm telling you, with calibration that you can do with most models, we can get through that fear, and it will save you tons of issues down the road, because subjectively, it's really hard to do loan migration subjectively, right? If I don't know what you've weighted on debt service coverage, I just know you recommended this was a 4. It's really hard for me to say, well, if their debt cash flows decreased by 50%, how does that change the credit risk? So trying to get the more objective you can get a score, the easier downstream CECL stress testing and all these things are going to be for your financial institution on that. So I think that's it, Thomas. I think you have one more maybe poll question.
Yeah, nope. Actually, I forgot we had this last one, but just wanted to open up the floor to anybody on the call. How can Abrigo software help you in today's economic environment? Whether it's gain better insight into credit quality, maybe looking at automating some of the spreads and ratio calculations, centralizing some of the storage of documents, or maybe you're dealing with kind of increased volume of special assets and loan workouts. Definitely something we can help with. And I want to be conscious of time, and so two other quick things. You'll receive an email from me later this afternoon with slides, recording, and a host of resources, as well as an opportunity to take advantage of a discount exclusive only to those that were on this webinar today to get $50 off of our registration to our Think Big conference coming up in May, as well as being in addition to, we also have an early bird special going on right now. So you'll definitely look out for that in the email if you're looking for a virtual conference to attend. We would love to have you. And then finally, and I'm going to actually close the poll here and flip over to our final slide. We are launching a 2021 business lending process survey, and that will also be in the email as well as in the slides. Some of the questions you answered today on the polls were very similar questions to ones on the survey. We had a couple hundred lenders and credit analysts fill out this survey last year, and it was really interesting data. So if you have a few moments, I think it takes 3 or 4 minutes to fill out, we would really appreciate it. And that way you'll be the first if you take it to receive the results, as well as be entered into a contest to win some Starbucks gift cards, or we may switch that to Amazon depending if the pandemic continues to go on in case your local Starbucks is closed. But I did see some questions come through. Like I mentioned, we will follow up after the presentation and get those answered. But I just wanted to thank everybody for joining the session today. If you have any questions, please don't hesitate to respond to the email you receive or reach out to Abrigo. I hope everyone has a great rest of their day, and we thank you for joining us on this webinar, and we hope to see you on a few of the other ones that we have planned for credit teams over the next few months. So thank you very much. Thank you, Rob, and have a great day.